Hey guys, it's Dan here. In this week's video we will answer the question, what is the value of a company? In today's video you will learn the three methods how companies are valued. So the first thing you have to understand when we're talking about the value of a company is that there are two types of companies. There are publicly traded companies and there are private companies. So what is the difference and what is the impact on the value of the company? Well, let's look at the public companies first. A public company means that the stocks of these public companies are traded daily on a stock exchange, so you can buy and sell them on a daily basis on a stock exchange, which means that the stock price will change all the time, as you can see on this beautiful chart here. That, on the other hand, means that the stock price times the numbers of stock gives you the market capitalization. So, in other terms, for a public company, it's very simple to know the value of the company because it's calculated kind of live all the time. So the market capitalization gives you the value of the company. So you can Google, for example, market capitalization of Apple and you will know the value, and that's the simple part, and it's very simple to evaluate because it has been done for you on the stock market when it comes to a public company. On the other side, when you're talking about a private company, it's much more complicated. So what is a private company? Well, it's when the stocks of this private company are held by a private individual or by a private company. That means these stocks are not traded daily, which means there is no live quotation. You cannot know the stock price at 2 o'clock on Thursday of a private company. That's not how it works, because there is no such live quotation. And exactly this part makes it difficult to know the stock price, and therefore because the stock price gives you the value of the company, it's difficult to know the value of a private company on a daily basis. So how do you calculate, how do you know the value of a private company? This is what we're gonna talk about in this video right now. The first method to value a company is called the DCF method, which is the discounted cash flow method. This sounds super fancy. Let's look at an example. You will see it's not that complicated. It's quite easy to understand. The first thing I would like to point out is when you are evaluating a company, it's the same on the stock market with the stock price. When you look at my stock price video and why it fluctuates, you will understand it. When you're analyzing a company's stock price, it doesn't matter if it's public or private, you are not looking at historical data, historical performance. You want to know what to expect from the future. So the idea is actually what is the future potential? This is what really matters. So in this, imagine we are today and we want to know what is the future value of this company. So what you do here is actually these 4 steps. First of all, you need to estimate future free cash flows. So what does it mean? Actually, you will look, let's say, at a horizon of 4 years, for example, and you will look at this company and imagine this company will give you future free cash flows. Concept of free cash flow is pretty simple. Is what is the cash generation of the company? So actually it's cash ins minus cash outs. It gives you operating cash ins minus investing cash ins, gives you this free cash flow. So the idea is, so what are my future free cash flows? Imagine here it's 100 the first year, 110 the second year, 120 the third year, and 130 the fourth year. What you also have to understand is that $100 in 10 years are not $100 today. So the next thing you have to do is estimate the weighted average capital costs. Again, that sounds super fancy. Actually, it's pretty simple. You have to understand, okay, what are the costs of the company? How much are they paying interest on their debt? How much is the shareholder return and these kind of things? Let's imagine here that the weighted average capital cost, which short is WACC, imagine it's 6%. That means you are discounting, so meaning actually here the $100 from year one, you want to bring it to today's value, and to do that you have to use a formula I'm going to present you very shortly, but I want to show you the concept first. is actually you have to take each of the free cash flows and discount them, so bring them to today's value using this weighted average capital cost. Okay, now that we have done the theory, let's put it on paper and do a little math exercise here. So as I mentioned, we have 4 different cash flows. We have a WACC of 6%. Now let's look at how we could calculate and how we can discount it to today's value. So the formula is very simple. You take the free cash flow of year 1, for example, and you divide it by 1 plus the interest rate power of 1. Sounds a bit complicated, very simple in practice. Let's go through it. Let's look at the first cash flow, which is 100 in the first year, and my interest is 6%. So that means I have my 100 of free cash flow divided by 1.06 because it's 6%, power of 1 because it's the first year, and when you do this calculation it gives you a value of 94, which means that the first cash flow you have here, the 100 you have, if you discount it over 1 year with 6%, gives you less, which is not. So my 100 become 94 for the first year. We do it for the second one, 110 for the second year, still divided by 1.06, which is my interest rate, power of 2 gives me 98. So the second flow is valued at 98. Third one, 120 divided by 106, power of 3. So that's this one, gives me 101. And the last one, 130 divided, this one gives me 103. So what does it mean? So if I make the sum of all the 4 here, so the 4 numbers, I get what is called the net present value. This is exactly what I was explaining, and this famous net present value is the sum of these 4 numbers, and that's 396. That means that these 4 flows discounted over the different years with this same weighted average capital cost of 6% leads me to a net present value of 396. Okay, now that we have calculated our net present value, we have already done the first 3 steps. By the way, if you don't want to calculate it manually, if you have Excel, just open Excel, type in the formula equals NPV, and then it's just easy. You enter the interest rate and a few values and you get to 396. Very simple, you can do it in 1 minute. So these were the 3 first steps. And the last step is, now that we have our net present value of 396, we know what is also called our enterprise value. But enterprise value is not the value of the company, because enterprise value you need to retrieve from this net present value, you need to retrieve net debt to get the equity value you are looking at. So what does it mean? Again, sounds complicated, but it's pretty simple. We know that we have these 4 cash flows that we have discounted to our net present value of 396. Now we have to look at what is how much cash and how much debt does this company have. So here I made an example. Imagine this company has 50 of bank loans, so 50 of debt, 10 of cash. And what is net debt? Net debt means debt minus cash, because you can pay back debt with cash. That's why you retrieve the cash here. So you do debt minus cash, that's 50 minus 10 leads to 40. So let's quickly do it together. Net present value 396 minus my net debt, we just calculated, it's 40, which means that my equity value, so the value of my company without debt, that's very important, is 396 minus 40, which means it's 356. What does it mean? Imagine that these free cash flows were millions of dollars. For example, this was $100 million. That would mean that my company would have an equity value of $356 million. In other terms, the value of this company is $356 million. Now that you know how the discounted cash flow method works, you can probably imagine why a lot of startups especially are overvalued. Because look at our model here. We are talking about future values, so it's not made out of stone. Obviously, it's very flexible here. Obviously, if someone wants to sell you this company, they will try to maximize the future cash flows by saying, yeah, we have a great product, and all these future cash flows, by the way, are much higher, and after that it's just gonna go absolutely nuts. Make sure that the free cash flows show the real picture. If they seem to be completely out of this world, maybe it's the model is overvalued. And also when you look at the WACC, so the weighted average capital cost, you will see if you play a little bit with it, the higher the value here, the smaller the amounts will be. So let's say if you take 10%, the numbers will be smaller, so the value would be lower. So if someone wants to sell you a company, they will make this one the smallest as possible, because obviously if you only have 3% here, you will lose less value by discounting the flows, which means you will have more equity value at the end of the day. So just make sure that your model is reflecting the future reality. So the cash flows should be in line with expectations, and the interest rate that you are discounting should be in line as well with expectations. So this is very important. Now that you have understood the DCF model and the pros and cons of it, let's move to the second method, which is less challenging and easier to understand and to explain. So let's move on to the second method. So the second method is called comparable company analysis. In this case, you are not looking only at yourself, at your future cash flows, but you are looking at similar companies to you, which is called then a peer group. So let's find out how it works. In this case, the goal is to find similar companies that are publicly traded. It's important that they are similar to your business, so same industry, same size and these kind of things, but also that they are publicly traded, because don't forget what I mentioned at the beginning. You have publicly and you have publicly traded and you have private companies. Private companies are difficult to value, but publicly traded companies are always valued each day. So it's very simple to get all this information because it's already available. So your goal here is to match your private company with publicly available records from public companies. So that's actually a pretty simple approach, which is also called the peer group approach. We're looking at 3, 4, 5 similar companies to you that are publicly traded, and then you're looking at the financial metrics. And basically, usually you're looking at two financial metrics, EBITDA multiples and price earnings ratios. If you are not familiar with these terms, I will explain it right now, but I made an entire video as well called Financial Metrics at Different Stages of a Company. Link here and in the description below if you want to know more about that. To give you a quick overview, and I've seen that many times, the multiples method, and especially the EBITDA multiples method, is used all the time. I give you an example. Let's say you have picked 5 publicly traded companies that are similar to you, and imagine that these are the average numbers that come out of the analysis. Imagine that the market capitalization of these companies in average is $100 million, and that the last 12 months EBITDA, so the last 12 months operating profits of these companies, is $5 million. So what is the EBITDA multiple? It would be the market capitalization, so the value of these companies, divided by the last 12 months of operating profits. And in this case it would be 100 divided by 5, and that would give you an EBITDA multiple of 20. So what does it mean for us? It means, well, that the similar companies to you that are similar companies to us that are publicly traded, they trade at an EBITDA multiple of 20. So what does it mean for our value? Let's imagine that our company has an EBITDA of $2 million. So then it's very simple to do actually. If my EBITDA is 2 million, I multiply it by the average EBITDA multiple of my peer group, which is 20. So 2 times 20 leads to a company value of myself, an equity value of my private company of 40. So here you see it's pretty simple. The same, you can do it also with the price earnings ratio, which is basically the stock price divided by the profits of these peer group companies, so the publicly traded companies you have picked. Simple example here again, imagine the average of the ones you have picked, stock price $20, earnings, so profits per share, imagine it's 50 cents. So the PE ratio or the price earnings ratio would be 20, which is your stock price, divided by the earnings per share, which is 50 cents. So 20 divided by 50 cents gives you a price earnings ratio of 40. So what does it mean for my company, for my private company? It means that imagine that my private company has net profits of 1 million a year, then the company value would be 1 million times 40, so 40 million. As you can see, well, in this example we fit perfectly, but usually you try to match these two and see what comes out, but it gives you a pretty good estimation about what your company is valued. As you can see here, what is a bit tricky, two cons in my opinion. First of all, the peer group selection really matters because it really depends who you are picking. Obviously, if you are picking highly valued companies, well, then it's going to be good for your company because you're comparing it, and for the opposite it would be bad, obviously. So this is the first con, or the first, let's say, flexible metric. And the second one is obviously there has been a lot of talking about EBITDA, so about the operating profits, because usually EBITDA is a little bit overhyped, and it's actually pretty simple to pump it up a little bit. So obviously, because it's accounting, so if your EBITDA of your multiples group, of your peer group, is much higher than the reality, then obviously you will take this inflation into account and put it into your company. So that's a bit the challenge of this method, but otherwise I've seen that many times in mergers and acquisitions that they use this method. Now that you know this method and the pros and cons, let's move on to the third method. Method number 3 is called Precedent Transactions. Here the goal is to find historical deals that took place in the same industry, meaning that companies have been bought in the same industries as yours, for example, historically. So in this case, you consider that the sales price of these acquisitions had a sales price, and the sales price of these acquisitions was the value of the company. And usually what you do, then you calculate 3 ratios or more and see what comes out. For example, imagine you had 2 transactions in the past with companies that were similar to you. So you look at the deals that took place, the mergers and acquisitions deals, and imagine that the sales price, so the acquisition price of this company divided by their revenue, imagine the ratio was 2. That means that, imagine if your company has 5 million of revenues, then the equity value, so the value of your company, will be 2 times 5, so that's going to be $10 million, for example. The same with the 2 other metrics. Imagine the sales price of the acquisition divided by the operating profits. Imagine the ratio was 5. In this case, imagine your EBITDA is 2 million. So 2 million of EBITDA times the ratio, 2 times 5, leads also to your equity value of 10. And same for sales price divided by free cash flow, for example. The ratio, imagine the historical ratio was 10, so 10 times more sales price compared to the free cash flow these companies had. Imagine your free cash flow was 1 million, then your equity value would be 1 million of free cash flow times 10, which was the ratio, and you would have your equity value of 10. So in this case, this method is less used because there is a big issue with this one, and it's linked to precedent transactions. So actually there are not so many deals usually in your industry. So maybe a deal that took place, maybe it took place 10 or 20 years ago. So these values would be a little bit outdated. That's why a lot of companies or a lot of mergers and acquisitions companies don't like to use this kind of method, because it's usually a little bit outdated. What is interesting with this method is it takes into consideration the premium that the companies are paying. What do I mean by that is, in the previous two methods, we were not talking about acquisitions. We were just either checking our future free cash flows, or we were comparing it to public companies. But in this case, we are talking about deals, so real sale prices which have been paid. And usually what you have to understand is that the sales price of a company, if you are acquiring a new company, you are always paying a little bit of premium. You are paying a little bit extra to make sure that you get all the shares and that the current shareholders agree selling to you. So now that you know all the three methods, I would like to know which one makes the most sense for you in the comment section below. I would also like to tell you that I post once a week every Sunday, so if you like these kind of topics, market finance, corporate finance, make sure to subscribe to my channel, make sure to like this video as well. It takes me about 7 hours to do. Like button 1 second, so make sure to like it. See you soon guys, enjoy your week, bye bye guys.